Ladies and gentlemen, good day and welcome to IFGL Refractories Limited Q1 FY27 earnings conference call hosted by Monarch Networth Capital Limited. Before we begin, a brief disclaimer. This conference call may contain forward-looking statements about the company which are based on beliefs, opinions and expectations of the company as on date of this call. These statements are not guarantee of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participants' lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand over the conference to Mr. Sahil Singhvi from Monarch Networth Capital Limited. Thank you, and over to you, sir.
Thank you, Pari. Good evening, everyone. On behalf of Monarch Networth Capital, I welcome you all to the Q1 FY27 earnings conference call of IFGL Refractories Limited. We are pleased to have with us the management team represented by Mr. Mihir Bajoria, Managing Director, Mr. Mukesh Rawal, Director, Mr. Manoj Rakheja, Chief Executive Officer, Monocon, Mr. Amit Agarwal, Chief Financial Officer. We will have the opening remarks from Mr. Mihir Bajoria, which will be followed by a Q&A session. Thank you, and over to you, Mihir, sir.
Hello, good evening, ladies and gentlemen. Thank you for joining us on IFGL Refractories Limited Q1 FY27 earnings conference call. I am joined by Mr. Mukesh Rawal, Director and Chief Executive Officer, India, Mr. Manoj Rakheja, CEO, Monocon, and Mr. Amit Agarwal, CFO, IFGL, and SGA, our Investor Relations Advisors. Our results and investor presentations have been uploaded in the stock exchanges and company websites. We trust you have had the opportunity to review them. Let me start with industry updates followed by our performance for the quarter. We face multiple challenges in FY26, including geopolitical uncertainties, supply chain disruptions, delays in traffic, funding and rising input costs. Hello?
Yeah. Go ahead.
Sorry. In rising input costs. Despite these headwinds, IFGL delivered growth ahead of the underlying industry performance and was supported by strong growth in the domestic market, along with continued customer additions and expansion of our wallet share across key customers and in our global business. On the industry front, India continues to stand out as the strongest major steel market, with steel demand forecast to grow by 7.4% in 26 and 9.2% in 27. And IFGL, with a large presence, is in a very strong position. USA steel production has been robust and has grown 6% year-on-year, which is reflected in the results of our US subsidiaries. Europe steel demand is bottoming out, with growth expected to revive in 26 and 27. Financial results as published by the big steel groups in Europe, such as ArcelorMittal Europe, Nucor USA, SSAB Europe, etc., present a picture of overall growth in the industry. Speaking of IFGL and its positioning, IFGL delivered a strong performance with consolidated growth of 13% year-on-year in Q1, amply supported by our Indian and overseas operations. Details will be shared by my colleagues Mukesh and Manoj. As I take on my expanded responsibility as Managing Director, I remain committed to building on the strong foundation established over the years. The senior management team in IFGL is now all placed and is completely focused on driving IFGL to higher levels and delivering greater value to its shareholders and investors. With that, I will now hand over the team to discuss the operation and financial performance for the quarter and the year in greater detail. Thank you, and over to you, Rawal.
Thank you, Mihir. Good evening, everyone. It is a pleasure to be speaking with all of you today. As Mihir mentioned earlier, I will be transiting into the role of Chief Executive Officer, India Operations. Against the backdrop of strong steel demand and continued capacity expansion of steel manufacturing capacity in India, as well as forecast to grow by 7.4% in 2026 and 9.2% in 2027, we remain very positive about the outlook of our domestic business. Now I will take you through the financial performance of Q1 FY27. Revenue for Q1 FY27 stood at 297 crore, registering a 8% year-on-year growth in our standalone business, with domestic revenue growing 7% and export increasing 9%, and we remain confident of growing ahead of underlying market over the medium term. Coming to profitability, EBITDA for the standalone business stood at 31 crore in the current quarter, a decline of 17% year-on-year. The contraction was primarily driven by higher raw material costs arising from geopolitical uncertainties and supply chain disruptions, along with elevated LPG costs due to availability constraints during the quarter. To mitigate these pressures, we have implemented appropriate price increase across customers and product categories. However, given the nature of our business, there is typically a time lag in passing on cost increases, with some of the elevated costs being absorbed in near term. We expect the benefits of pricing actions to flow through progressively over the coming quarters. Needless to say, our IFGL team have risen to the occasion and registered our manufacturing plants are operating without hindrance in spite of headwinds and supply chain disruptions. As mentioned earlier, we are having extra impetus on new products and categories such as bricks, casting flux, and various products from our group company, Sheffield Refractories. IFGL also is working very closely with Monocon, who has its own engineering division, to bring some of the advanced refractory application equipment to the market. With that, I would like to invite Manoj to provide an update on our overseas business. Manoj, come in, please.
Yeah. Thank you, Mukeshji and Mihir. Good evening, everyone. Our focus remains on strengthening our product portfolio, improving operational efficiencies, and leveraging our global capabilities to cross-sell products across multiple geographies. In Q1 financial year 26-27, we saw improving demand conditions across our key overseas market. In UK, British Steel is now in public ownership, alleviating much concerns about longevity of British Steel manufacturing operations, bringing cheer to our group companies in UK in terms of long-term visibility of business and growth opportunities. Further, we are told from market sources that the administrators of the erstwhile Liberty Steel Aldwork, now called Specialty Steel, is also looking to restart their Rotherham melt shops sometimes in November to December 2026. Amongst the above positive lights, we cannot ignore headwinds like British Steel producing at a very minuscule levels in Q1 due to their blast furnace problems, which hopefully will be rectified in Q2, and the spurt in ocean freights due to the prevailing geopolitical situation, which has had a big impact on our operations in UK and China. Monocon UK and Monocon China operations continue to make inroads into new geographies with multiple new products, and year-on-year turnover has increased significantly. Business turnaround remains key focus. Sheffield Refractories product portfolio integration with our IFGL India operations is going on well and at desired pace, including regular interactions and joint visits to the customers. We have also commenced production of Sheffield Refractories plastic ramming mass at our IFGL Vizag facility. Overall, our Monocon and Sheffield Refractories revenue have a double-digit growth year-on-year in spite of the headwinds mentioned above. US business has delivered a revenue growth of double-digit year-on-year. Cost optimization and efficiency initiatives also supported a positive trajectory in margins. The results are testament of the resilience of our US operations and teams to deliver consistent results. The US steel market remains healthy, supported by investments in new facilities as well as modernization and expansion of existing plants, while the broader Americas region, including Canada, Mexico, and select Latin American markets, continue to offer attractive opportunities. Overall, we remain positive on the outlook for the Americas and see the region continuing to be an important driver of our international growth. At Hoffman Ceramics, we have been able to maintain order book at similar levels compared to corresponding periods. New initiatives undertaken across product enhancement, customer additions, and cost rationalizations are beginning to show progress. Turning around the business remains a key priority, and we are taking multiple measures to improve performance, with the objective of reducing losses and achieving break-even by the end of financial year 27. With that, I would like to hand over to Mr. Amit Agarwal, CFO, for financial performance. Thank you.
Thank you, Manojji. Let me give you a brief on financial. Starting with the standalone financial highlight. Total income for Q1 FY27 stood at rupees 299 crore, reflecting a 7% year-on-year growth. Gross margin stood at 43% in Q1 FY27, compared to 47% in Q1 FY26. Impact on gross margins was on account of increase of raw material prices due to supply chain disruption and geopolitical tension. EBITDA for Q1 FY27 stood at 31 crore, down by 17% year-on-year. EBITDA margin were impacted on account of lower gross profit and also on account of significant surge in fuel prices in current quarter. PAT for the current quarter stood at 16 crore, a growth of 7% year-on-year. Breaking it down further by domestic and export sales, the domestic business continued to demonstrate strong momentum, delivering 7% year-on-year growth in Q1 FY27. Export revenue has shown sharp surge and grew by 9% year-on-year. Increasing operational efficiency and visibility will help us from an optimistic view going forward. Let me now move forward to consolidated financial highlight. Our consolidated financial highlight also include our international subsidiary. Total income for Q1 FY27 grew by 13% year-on-year to rupees 515 crore. Gross margin stood stable at 48%, showcasing our resilience and operational efficiency built up. EBITDA for the quarter was 40 crore, registering a 2% year-on-year increase. As mentioned, EBITDA was impacted due to increase in raw material prices and surge in fuel prices, impacting the domestic margin, which has overall impact on consolidated numbers. Profit after tax stood at 17 crore, an increase of 58% year-on-year. PAT margin for the quarter stood at 3%. With this, I shall now leave the floor open for question and answer. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Krishna from Prathamesh Invest. Please proceed with your question.
Good afternoon, sir, and congratulations on the good set of numbers. So my first question is, our overseas subsidiary has shown good growth. Can you elaborate what changed? Also, the margins stood strong. Any color on margin outlook?
Hello,
Manoj?
this is Manoj here. So, as you mentioned, Krishna, overseas subsidiaries top line have had significant growth. The important reason, as we discussed earlier also, was from Americas. Americas margins are also quite robust. In terms of individual breakup of the margins, etc., we do publish our segment results in the consolidated results, what is published. And if you can see from there, quarter on quarter, there has been significant improvements on those results. Individual company-wise details we are unable to divulge at the moment.
If you can, Manojji, just answer them on this future. How do we see? I think it will answer their query.
Going forward, we expect the momentum to be maintained for all the subsidiaries which in consideration. And as I mentioned, on individual operations of UK, Europe, America, and Germany, in each area we have taken significant steps to see that we keep the momentum of growth, and the companies which were in red, the objective is to bring it back to black and turn the operations around. So our operational focus and efficiency remains. We are expanding our product portfolio across various geographies, helping us to get the numbers where we wish to.
So my second question would be, how was being the subsidiaries performing, especially Monocon, that has been under some pressure last year?
Yeah, so as I mentioned, for Monocon, we are now taking a very aggressive stand of introducing new products as well as getting into new geographies. In my last conference call also, I mentioned we have put a robust team across the globe to help Monocon drive the growth plan which we have set forth. Second, we have had some positive news from the UK industry, where British Steel is now in public ownership, so the business longevity and visibility is much better than before. And in November, December, if the other melt shops, as I mentioned in my opening remarks, open, it will be much more positive and robust for Monocon operations going forward. But overall, we are quite buoyant about the way things are moving, and we will continue to tread along that path.
Thank you, sir.
Thank you. The next question is from the line of Snehal Surna from Star Broking. Please proceed with your question.
Hello, am I audible?
Yes.
Yes.
My question is regarding the tech transfer from product from Sheffield phase 1 has commenced. Can you let us know on how much time it will take for full transfer of capabilities, and by when do we see those products being available in the domestic market?
No, so as I mentioned, This is Manoj here. So as I mentioned, Sheffield Refractories phase 1 plastic ramming mass has already started to be produced in our IFGL Vizag facility. So that is already complete. And now marketing, trials, and all the other relevant activities relating to promoting the product is ongoing now. In terms of the various other products, joint visits to the customers, interactions with the groups, technology transfers, all that have been put in place. So, but as you know, these products will take time to mature in the market. It will undergo a full set of trials and accreditation at the customer's end. So the process is already on now.
Okay, thank you.
Thank you. The next question is from the line of Amit Ahuja from CJ Capital. Please proceed with your question.
Congratulations for the good set of numbers. So I have two questions. The first one is growth in the domestic business was like 7% compared to the higher growth number in the previous year. So how has been the demand environment, and is there any market share loss? And my second question is also the EBIT margin were down by like 17%. Is this because of competitive pricing and intensity? Like what has impacted the margins sharply? Thank you, sir.
I think this is Amit. Sir, this growth number, what we are talking of domestic business, the base number, has grown up. So that's why in terms of percentage, it's looking small. We are almost have touched double digit. So we have to see on consolidated basis, including the domestic business as well as export business. This time we have done very well in terms of export. But we continue to, I think, give importance to domestic business, and we target to increase by double digit at least for at the year end.
Okay. And what is the competitive pricing?
No, see, with respect to dip in EBITDA margin, as we said that because of geopolitical condition, our raw material prices has gone up, and the LPG or the fuel prices have gone up like anything. Although we have been able to get a price increase from the customer, but that was not enough to compensate the overall price increase in input cost. So this is the major reason for dip in EBITDA margin as compared with corresponding quarter.
Oh, okay. Thank you.
Thank you. The next question is from the line of Sahil Singhvi from Monarch Networth Capital. Please proceed with your question, sir.
Yeah, hi. So my first question is on the EBIT margins that we've shown for the Europe business. Now, after some quarters of reaching towards the break-even, especially Q4 was very close to break-even. We've again started going towards 9% and -8%. So what's exactly happening over here, and do we expect to again break even this year, or how do you see that evolving for the Europe business?
Sahil, is this with respect to standalone business or Concall?
This is the segmental split that you give in the financial result, the Europe category.
Okay. I think Europe per se, I tell you, Europe consists of two companies, basically majorly Monocon UK and Sheffield Refractories. Okay. So both have individually performing good, but as mentioned by Mr. Manoj, that because of lower performance of British Steel, one of our customer, our sale in Sheffield Refractory was considerably low. So that's why this quarter is exceptionally low for Sheffield Refractory. Otherwise, Monocon is doing better from the previous quarter, and we are moving towards the break-even. So that we maintain that Monocon UK per se, we are reaching towards break-even, and that continues to do so. And for Sheffield, this is, I think, one of the quarter. Manoj can further put light on this, that quarter two will be normal as usual, I believe.
Very much true, Amit.
Yeah.
Because British Steel, hopefully in quarter two, with the blast furnace coming back in operations, their sales, etc., will come back immediately. It's not that we have lost any orders, etc. It's just because of the timing difference. The plant's not producing, so we were not able to sell much there. But it's quarter two, we will be back where we should be for Sheffield.
So has the margins also affected at Sheffield because of this low offtake in Q1?
Yeah.
Okay. Second, I wanted to understand, in the opening remarks, we heard that there are some more price hikes to be expected. So would this be across all products, or would this be across geographies, or how should we think about it, and what kind of benefit do you expect on the margins because of this?
So see, I tell you, this is not all across evenly distributed. So every contract has its own feature, and accordingly we are going and getting the price increases. And these are all temporary price increase based on the input cost which has increased on this geopolitical front. So we are trying to get and continue this price increase as long as we are being impacted by input price cost. Otherwise, no additional margin on this account we see.
Okay. And on the standalone, we are seeing a big bump up on the staff cost, which is roughly 28.7 crores, roughly 10% of the top line. So should we assume that the staff cost will continue at 10% of the top line? Because absolute numbers, it's a jump compared to how.
If you compare with quarter four number, which is around 24 crore, there is an increase. If you compare this with quarter one FY26, this is at the similar level. So 10%, obviously, this is 10% of overall revenue, and we are trying to manage this, and we do not expect this to go beyond this.
Okay. Okay. But on the console front also, there is a big jump. So 84 crores versus 76 and YOY and 77 QOQ. So is it safe to assume that this run rate will continue, and what is composing this increase?
No, if you see again for console also, for corresponding quarter 76 to 77, so only 1 crore price hike. But if you compare this with last quarter, there is an impact because I believe because of this some provision reversal happening in last quarter. But employee cost is our focus area, and we are working on it.
Okay. Okay. Now, with respect to a longer term guidance, like we were maintaining for one particular time that we can achieve a 12% EBITDA margins. Do we stick to that kind of guidance, and is that possible on the console business?
See, console business, we are trying to achieve double-digit EBITDA margin, and it all depends on how the geopolitical situation stand and overseas demand stand with us.
Okay. Okay.
But we'll be back again for sure on this.
Okay. Okay. With respect to Liberty Steel restarting, is there a possibility to get any kind of lost dues that we had historically?
No, for Liberty Steel, see, this is not under the erstwhile management. Now Liberty Steel is under the administrators, and they have renamed as Specialty Steel. So the old dues, because of being unsecured in nature, that the administrator will deal with it in due course once the new buyers are in place. But given the historical situation, how things turn out, I very much doubt there would be anything which is forthcoming from that side. But the silver lining is, if the operations start, we can start reselling the products. We have which we used to have a big sales and a big service team placed in that plant. So in that way, our monocon operations will get a big impetus once those operations start.
And when do you expect this to reflect in our revenue numbers? I mean, any timeline on this?
See, market sources say this plant, melt shops would be looking to restart sometimes November, December 2026. Okay.
Okay.
Hopefully, we are also keeping a very close watch on this. We also had meetings with their operational and procurement team also. So, things are in motion, but time will tell once they restart. But as of now, I can say we are very positive and optimistic about the whole thing.
Got it. Got it. And sir, you said in your opening remarks that we have been adding some new products and trying to enter new geographies at monocon. If you can give some more details, which product are these and which are these geographies where we are trying to enter?
So in terms of products, see, we are into iron and steel. So there are refractories relating to iron and steel. Also, we are trying to get into the foundry industry. Again, primarily with refractories in the similar family and nature of application. And in terms of geographies, it is all spread over. See, monocon has operations in UK, China, and we have, as you have seen, we have opened an office or company in Australia. Recently, IFGL Monocon has opened an office in Saudi. So, the operations will be spread all across, and there are a lot of these areas which do present growth opportunities for monocon, which we are trying to really capitalize upon.
Sure.
Manoj, can I come in? Manoj,
yes,
on
please.
This one, expansion of monocon market, I think we have a very strong positive customers' feedback from Mexico and USA. So these products will be also introduced in this market.
Sure. Good to hear that. Thank you for answering my question. All the best, sir.
Thank you.
Thank you. The next question is from the line of Saket Kapoor from Kapoor & Company. Please proceed with your question.
Yeah, namaskar, sir, and Thank you for the opportunity. As you were alluding to the improvement in the EBITDA margin on a consolidated basis to double-digit number. So, sir, if you could just explain or give us some more light, what factors are you think are in the annual that will lead to this EBITDA margin improvement? So, for the first quarter, we were closer to 8%, 7.7, and taking into account the steps and the rationalization, cost rationalization just spoken about, what should we anticipate going ahead in the improvement in the EBITDA margin, sir? Some color on the same.
I think, Saket, we have been talking to bring Monocon UK back in black. So if we turn that company into black, our EBITDA margin will automatically have a positive impact on overall thing. And with US coming to more than double-digit margin, it has already added to our EBITDA margin. So it has to be seen in each and every company segment-wise, and we are working with each and every company to bring the EBITDA margin back what it was there in past. And we do see an improvement in US and Monocon UK per se at least.
So, Amitji, what was the loss contribution from Monocon for this quarter and for the last financial year?
Yeah, I would not get into the breakup of the loss number, but I would surely say that number has come down from last quarter to this quarter for Monocon UK.
Just to dwell into it, sir, when we look at the Monocon losses being being summed up, it is under the European entity only.
Yes.
So when we look into that number, as Sahil Bhai also mentioned, that on a Q-on-Q basis also, the losses have moved up from 3 crore to 7 crore. So has the Monocon performance deteriorated over the quarter, or what has led to this 5 crore change, sir?
Yeah, I'll tell you that I have answered this also, that Europe consists of major two entities, Monocon UK and SRL. So this quarter, SRL, because of lower offtake and everything, we had a lower margin over there. So that has added to it, which is not there in past.
Okay. And sir, we had, I think, so invested around 150 crore in our R&D facility in Odisha also. And so if you could just explain to us what are the benefits we are retrieving out of the same, and on the capex front, what have we outlined for the current financial year? And if you could just give us some more color, how are we progressing?
No, I think the number you are quoting is not correct. We have not spent 150 crore on R&D. We have spent around 20 crore on our R&D. Okay.
Sir, just to interrupt you, sir, R&D facility, we have created a new infrastructure in Odisha.
Yes.
If I correct me therein we have spent more than 100 crores.
No. You are mistaken.
Okay, sir. Please, now continue.
Okay. And on R&D front, I think Raval sir or Manoj ji can further update you on the benefit of it.
And capex front, sir? Yes, Manoj ji, namaskar. Boliye.
Yeah, as regards to, this is Mukesh. So, as regards to the R&D facility, like the works are very continuously going on. One is developing new materials which have been being done now and helping the Monocon UK products into the foundry market. Second is designing of very special product, that is your Thandish SEN for the thin slab caster, which are being designed in our R&D center for the USA market, which has given very good results, and the new product has been introduced into the US market, manufactured in USA. That is where it is given the big growth in the US market too. We are also looking into recycling a lot of materials, trying to use the recycled material in our mix as and where possible. Plus, we are now also putting in new team, augmenting our R&D team, and we are going by the market given situations in India where new products can be introduced too. So R&D is becoming a very good support to the whole sales team around the world.
Right. And lastly, sir, on the Chinese JV part, how is the progress and how much have we spent? And if you could give us some more color, how are we progressing and the commissioning date of the same?
Mihir, can you?
Hello?
Mihir, can you put on Chinese joint venture, please?
So basically on the Chinese joint venture, basically we've run into a couple of issues with the
No, I think
which we're trying to.
if I can update them on this issue, for this Chinese JV, we have applied for an approval with the Government of India appropriate authority, and we are yet to get any positive response from them. So they have advised us to apply for the same again, and on receipt of this approval, I think we'll be able to further announce anything.
Okay, so our earlier commitment and earlier plan are on hold as of now.
Yes.
So the product replacement part, I think, please. Yes, Mihir, please answer.
Actually, the thing is that because this is an Indian and Chinese joint venture, at the moment the government is, going a bit slow on these approvals of Chinese joint venture. So that's the primary issue.
Okay, sir. So I think, sir, the land acquisition part and things we have done in Gujarat, it was also pertaining to this JV only. So we have spent money on it. Okay. So we have made the investment in the land and other part, or what is the...
so far only in the land.
Okay.
So far it's only been done in land, and some money has been spent because we've been marketing mother's products. But that's not a large amount of money.
Because when we remember that it was about some product substitution or import substitution rather, which we were looking at through that, and that will be catering to the cement industry, if I'm not wrong.
Yes.
Correct me there.
Yes.
So in terms of, we are slow on the same, and we'll wait for the approval. And lastly, sir, taking into account your commentary and the brief given to investors in the presentation, do we think that worst is behind in terms of the profitability aspect and also the negative impact of the pass on of the raw material prices, and now going ahead we can expect these as a steady set of EBITDA margins going ahead? This understanding is correct on a consolidated basis?
See, this is Manoj here. If you ask me today, I would very much agree with that. But tomorrow brings another day, another news, and the world changes so fast, it's so difficult to predict. But what we see today, definitely what you are summarizing sums up the position very aptly. We can see the upshoots or the green shoots in the European steel industry. The financial results of the big steel giants have all been showing a positive number for the first 6 months. The steel plants which were closed are coming back in operation. So, all in, and fingers crossed, hopefully it keeps like that, So definitely the worst is behind us.
Thank you, sir. I join the queue. And all the best to the team.
Thanks.
Thank you.
Thank you. The next question is from the line of Sanchita Sood from Robo Capital. Please proceed with your question.
Hi. Thank you for the opportunity. Just one question from my end. I apologize if it's a repetition. I joined the call a little late. But I just wanted to know, what is the peak revenue that we can do on our current capacity, and what will it be post all expansions and CapEx once that's completed?
I don't think we have any number as said that what is the peak revenue we can do with this current capacity and all. But in past we have said that with addition of this MAC carbon and casting flux to new line addition, we can add additional 150 to 200 crore at peak capacity for that two particular products.
Sir, could you repeat the number once?
what I said that in past we have spoken about the addition of two new product line, matte carbon brick and casting flux. We can add around 150 to 200 crore on account of these two new product line at peak level.
Okay, got it. That's all from my end, sir. Thank you.
Thank you. Ladies and gentlemen, that was the last question from the participant. Now, I would like to hand over the conference to management for their closing comments. Thank you.
I hope we have been able to answer most of your queries. We look forward to your participation in next call. For any query, you may contact SGA, our investor relation advisors. Thank you.
Thank you.
Thank you all.
On behalf of Monarch Networth Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.